of G Steel. Draw up
Okay,
the
the one
income
which-
statement for the year ending 30 September 2209 and the balance sheet as at that date. Can you see that one?
Page 24.
Page 24 of that
It's-
handout that I sent you that is handwritten.
Yes, it starts with this one, with the petty cash book.
After petty cash book, we have the final statement of final accounts for sole trader. You can use that.
Yes. I can see
We
it,
have the
yes.
income statement.
Yes.
So we want to know how to prepare the format and the preparation of the income statement and the
Okay.
statement of financial positions. Okay.
Okay.
So income statement is a financial statement that shows how profitable a business was over a given reporting period. That is what we call it, income statement. Okay.
Okay.
So the statement displays the business in revenue, gross costs, gross profit, and expenses. So we're going to outline the format and how it is done. And then we also have a statement of financial position, also known as balance sheet. It's a statement that lists the assets, liabilities of a business as of the report date. So we have example there. The following trial balance of G Steel. Can you see the example?
Yes.
So the following trial balance of G Steel, draw up the income statement for the year ending 30th September 2009 and the balance sheet as at that date. So we have the trial balance. Then down there we have the inventory as at 30th September 2009. So now you write the heading of the business. Now this one you write there G Steel income statement for the period ended, ended 30th September 2009. Okay. Then you underline. So every time you make a statement, it must have headlines, headings. That is a requirement of your study. Okay. So you start by identifying the cells, where the cells are. So you have here now in Kenya, here we use shillings, and here we have shillings. So we write there, we get the sales amount. So we have the sales here. So the sales, you get where the sales is, okay? 400, can you see it?
Yes.
8400. And then you less what you call returns. You less return inwards. Return inwards are sales that had been made. They're being returned because of different reasons. So you deduct them from the sales. So in this question, it's 1540. So you deduct 1540 there. You get what we call the net sales. Net sales. Can you do the computation there and you tell me what the net sales?
Sorry?
Do the computation, sales minus return inwards, what do you get?
Oh, sorry.
You don't have a calculator?
I don't have at the moment, but let me use my phone.
Just a minute.
It's that 378,860.
What is the value?
378,860.
378,860. 69.
860.
Huh?
Yes, 378,860.
37.
378,000. 860.
860. That is the net sales,
Yes.
isn't it?
Yes.
Then you less cost of sales. Come and compute what we call cost of sales. You start with the opening stock or opening inventory. So you identify where there's opening inventory. Opening inventory in this question is 41,600. Can you see it? 41,600 opening inventory.
Yes.
And then you add purchases. You add purchases. Purchases is 188 for 30. 188, 430. And then you add also, you add carriage inwards if it is there, carriage inwards. Carriage inwards, it is a transport cost when you buy goods for resale. So you add there 700, that is, and then you less return outwards. Return outwards. Return outwards is 34.
3,000. Yeah.
34.
10.
And then you get what we call goods available for sale. All goods available for sale.
200.
You take this 41,600 plus
200.
188 for 30 minus, you add also, sorry, you add 3,700, which is carriage inwards, you minus 3,410, which is return outward. You get what we call 230.
320.
320.
Yes.
320. So that is goods available for sale. And then you less closing stock or closing inventory. You less closing inventory, which is in the 44,780. It is down there after the trial balance.
Yes.
44,780. Then when you do that computation, you get 185. 185, 540. 185, 540. Then you get the gross profit here. So you take the net sales minus, this is now the cost of sales. The cost of sales is opening stock plus what you purchase minus the closing stock. So that is the buying price of the items you sold, which is called the cost of sales. How do you compute the cost of sales? You take the opening stock, the goods that were there at the beginning of the period, you add purchases, and then you less closing stock, you get what we call cost of sales. So purchases is a combination of both the cost of the goods you purchased plus the transport cost, which you call it carriage inwards, minus any of the goods that you had bought, you return back to the supplier. So that one is a combination, that is the composition of purchases. Then you get what we call cost of sales, you less closing stock, you get 185. And then now the difference between this and this, you get the gross profit, which is gross profit is 193, 320. In case we have any other income, like maybe discount received, you add there. In this question, we don't have any other income. Then you come here and list your expenses. You list your expenses. Yeah. So remember, this is the format. So in this we have carriage outwards. You start from the first one there. You have carriage outwards. We have carriage outwards. Carriage outwards, which is 2,100. Can you see it?
Yes.
Yeah, we also have salaries and wages. Salaries and wages, which is 61,400. We have warehouse rent. Warehouse rent, which is 3,700. And then we have insurance. Insurance, which is 1,356. And then we have motor expenses. Motor expenses. Motor expenses, which is 1,910. Can you see those one? And then we have office expenses. Office expenses from the trial balance. These figures we're paying from the trial balance, which is 412. And then we have lighting and heating expenses, lighting and heating expenses. Lighting and heating expenses, which is 894. And then we have general expenses, general expenses, which is 245. So those are the expenses from the trial balance. And then now you aggregate them. You get the total expenses. Then you write them to the extreme right, which is 72,017. So you take the gross profit, you deduct from the total expenses. If the gross profit is more than the expenses, what you get is called net profit. So net profit is where the gross profit is more than the total expenses. If the opposite is true, then it's a loss. So that is how we prepare the income statement. This is the format. And now when you're preparing the statements, you're going to learn how to prepare for other business entities like companies, partnership, and so forth. So this is the format that you're going to adopt. Are we together?
Yes, yes.
Now, after that, you also need to know how to prepare a statement of financial position. Sometimes we call it a balance sheet. A balance sheet is a statement that summarizes the total assets and capital. So it summarizes, it gives you an outline of the total asset. Assets are an item of value to a business and the capital of the business. So you write the total title here. So you write the title, and then you start with non-current assets. You start with non-current assets. So non-current assets are those assets we are saying are item of value to a business. And this item of value are subdivided into two. We have non-current assets and current. Non-current assets are those assets that stays longer in the business more than one financial year, and include items like land and buildings, plant and machinery, furniture and fittings, motor vehicles, equipments, computers, etc. So those are non-current assets. They stay more than 1 year. So you come here and you list them first if they are there. So here we have the premises. Premises is the same as building. So you write premises. So the value is 92,000. You write there 92,000. And then we also have motor vehicles. So we have motor vehicles. We have motor vehicles in this question, which is 13,400. We have fixtures and fittings. So right there, fixtures and fittings, which is 1,900. So right there, those are the only non-current assets we have in this question. After listing the non-current assets, you come here and list also the current assets. Current assets are those assets that stays in a business for a short period, mostly not more than one financial year, just more within financial year. And they include items like inventories, debtors or account receivables, cash at banks, prepayment, or cash in hand. So those are the assets in non-current assets. So in this question, we have the closing inventory. The closing inventory is 44,780. So right here, 44,780. And then we have accounts receivable. Accounts receivable, which is 42,560. Then we have cash at bank. Cash at bank is 5106. These items, you get them in the statement, in the trial balance. We learned how to make the trial balance, and then you add all the assets. So get here is 199,746. So those are the total assets. You write there total assets. Total assets. Then you write here capital and liabilities. Capital and liabilities. So you start with capital. The capital in this question is 68,843. 68,843. In case the business generated a profit in that particular year, when you generate profits like this one, the profit increases your capital. So when you generate profit, you add the profit you generated. If you generate loss, it reduces your profit, so you deduct from your capital. So your profit increases the capital, while losses reduces the capital. Then you less drawings. Drawings are cash or any item that is taken from business for personal consumption. That one reduces the capital, so you deduct it if it is there. So you less drawings. In this question, drawings is 121, is 22,000. So you less 22,000 here. And then now, if in case you have non-current liabilities, liabilities are obligations of the business. What the business owe others, what they need to pay. In case we have non-current one. So in case we have non-current liabilities are those liabilities that takes longer period to repay, like a loan, more than one financial year to repay. So in case it is there in a trial balance, you itemize it first before you go to current liabilities. Current liabilities are those liabilities that takes a shorter period to repay within one financial year. So here we have current liabilities. In this question, we don't have non-current liabilities. So it goes just right current liabilities. So we have accounts payable or suppliers or creditors, accounts payable. Another name for accounts payable is creditors. So you write there 31,600. 31,600. Then you total. So 199,746. So always your total asset should be, it follows the accounting equation which says asset is equals to capital plus liabilities. So when you add capital plus liabilities should always be equal to the total assets. So that is, it follows the accounting equation there, format or the outlay of statement of financial position. So that is how we make income statement. That is how we make income statement. Any question?
No, it's okay. So if like most of the income statement questions, it will look similar to this, eh?
Yeah, all of them. We are going to do much of them.
Yeah.
This is just introduction part of it.
Because me, I've just been practicing this paper only, this notes only.
Yeah, most of them will appear like this one. So after we've learned after we've finished now what we're going to do, I'll send you more questions on past exams to attempt. Okay. So now I want us to do something else that is related to income statement.
Okay.
We call them adjustments to final statement. So I want to send you the notes we're going to use.
Okay. I think I have the notes.
You have the notes?
Same one, right?
Adjustment to the final statement.
Is it the same one that you sent?
Let me see whether you have it. Let me see.
Yeah, this one which says adjustment of final statement, accruals.
Yeah, you have it.
Accrued expenses. Yes.
Oh, that one is what we want to. That one.
Yes, I have the notes. Yes.
You have it, isn't it? Okay, now that is what we want to do. So you have the notes, eh?
Yes.
Okay, you can open now. We want to see what we call adjustment to the final statements. Adjustments to final statements. So number one, we have what we call accruals. Number two, we have what we call prepayment. Number three, we have what we call bad debts. And number four, we have what we call provision for bad debts. Number five, we have what we call depreciation. So these are the things that you need to know how to adjust. They are always tested alongside the income statement. So once you know the format and how it is done, we go to the next item, which is adjustments of the final statement. So now we start with accruals. We start with the number one, what we call accruals. We start with what we call accruals. So accruals, we have what we call accruals, we have what we call we have what we call accrued expenses. So what are accrued expenses? Accrued expenses are those expenses that have already been incurred, but they have not been paid for. Accruals, we have accrued expense, an expense that is payable or due for payment, but has not yet been paid during the period. That is what the note reads, isn't it?
Yes.
So an accrued expense should be charged in the profit and loss, P&L. P&L is the same as income statement, account, and shown in the balance sheet as a current liability. So this accrued expense, you should charge it in the income statement and you transfer it to the statement of financial position as a liability. So you should include it in your income statement and it should be transferred to the statement of financial position as a liability. So we have an example there. ABC Enterprises incurred 100,000 for electricity for the year ended at 1st December 2009. 20,000 of this amount was not yet paid as at the year end. So required show the ledger accounts to record the above transaction. So the amount paid for amount that is supposed to be paid, amount payable for electricity was 100,000. So this is the total cost for electricity that particular year. Amount paid was 80,000. Outstanding amount was 20,000. So that is the arrangement. Okay. So now we're going to open here an account called electricity account. We're going to open here an account called electricity. So remember, we said in the double entry system, if you remember, receiving you debit and account losing you credit. So the amount that was paid for electricity in that year was 80,000. So when you pay 80,000, you credit your bank account, it's the one that is losing, and you debit your electricity account. So you're going to write here bank 80,000 or cash, whatever that amount originated from. But we are aware that this is not sufficient. That does not cover the entire amount for electricity. 20,000 is still due. It's not yet paid. So so now the one that is not yet paid, which you call it accrued, the double entry is you debit the expense. Double entry is that you debit the expense. Debit the expense and you credit accrued expense. You credit accrued expense. That is a double entry for it. That is the adjustment for it. So you're going to write here accrued electricity. You write here accrued electricity, 20,000. So total will be 100,000. And this one is the one that you're going to charge in the income statement, which you write P&L 100,000. So in your income statement, you're going to recognize the expense for electricity as 100,000, not 80, the one that you paid. Then you're going to open another account called electricity account, accrued electricity. Accrued electricity here. Accrued electricity. So here you have debited, here you're going to credit. You're going to write here electricity. You're going to write here electricity, 20,000. So this one you're going to take it to the statement of financial position. Therefore, you're going to write here balance, carry down the closing balance, which is 20,000. 20,000. 20,000. So that is how we treat accrued expenses. I don't know whether you have understood or we repeat.
Yes. I understood.
You've understood. Then now, number 2B, we have what we call accrued incomes. Accrued income, that is B, part of it. Accrued income, this is income that relates to the current year, but cash has not yet been received. So it is an income earned but not yet received. You're supposed to have been paid that income, but for other reasons, you've not been paid, but it's already earned. So how do you treat it? This one, you debit accrued income, and you credit income account. That is a double entry for this one. This is how it is treated in the account or how it's adjusted. So we have an example there. A trader lets out their premises for yearly rent of 200,000 shillings. So during the year ended at 1st December 2009, the tenant had only paid 150 in respect for the rent. 50,000 was still outstanding as at the year end. So there's a premises that was let out, was rented out, which attracts a rental income of 200,000 in the year. But unfortunately, 50,000 at the end of the year was not yet paid, which now we call accrued income. So you need to adjust that one. So you're going to have the rent income. We're going to have a rent income account. Rent income account. So we said, anytime you transact, you identify the account that is receiving, you debit, and the account that is losing, you credit. Now, when you receive rent, when you receive cash in favor for rent, you debit your bank account. It's the bank account that is receiving that amount of money. So you debit it. Then you credit the rent income. Remember, we also said all incomes are credited. Sales and all incomes are credited. So incomes are supposed to be credited. So the amount that was received, you debit bank and you credit this one. You write your bank 150,000. We are aware that 50,000 was not yet received. It's supposed to have been received. So here you write here now, we said you debit accrued income, and then you write here accrued rent income. You write here accrued rent income, which is 50,000. Then here you come here and open another account called accrued rent income. So here you write here rent, 50,000. So this one, you take it to the statement of financial position or balance sheet as an asset, 50,000. So right there, 50,000. So this one should be transferred as an asset to the statement of financial position. And this one, the total amount that should be recognized in the income statement for rent in that year is 200,000. So you write here profit and loss account, 200,000. So you recognize the entire amount that you're supposed to receive in that year. So this one, it follows the accrual concept of accounting. You recognize income in the period and irrespective of whether they were received or not. So long as you're earned in that particular year, you recognize them in that particular year. So that is what we call accrual concept. So that is now accruals. That is how we adjust accruals. Are we together?
So the accruals always affect the profit and loss account, eh?
Sorry?
The accruals, it
Yes.
always affects the profit and loss account.
Yes, accruals affect the profit and loss account and statement of financial position.
Okay. And such a question, will it be also, let's say if yesterday I was trying to attempt the question for preparing the ledgers.
Yes.
This question which was saying prepare a general ledger.
Yes.
And can I find such a question in there also?
No, accruals, you will not find them.
Mhm.
Accruals, you see,
It's always separate.
that one is separate. It's only additional information.
Okay.
So now let us go to the second one. We call it prepayment. We call it
Prepayment.
prepayment. So we have what we call prepayment. That is number 2. Prepayments. So A, we have prepaid expenses. Prepaid expenses. Prepaid expenses. So a prepaid expense is an expense paid, but it's an expense not yet payable, but cash has already been paid. Not yet payable. And in other words, not yet incurred, but you paid in advance.
Okay.
You understand? So it's
Yes,
something that
prepaid.
It is prepayment. You have paid it, but you have not yet incurred it. You just paid in advance.
Like rent, somebody
Like
can pay
rent, yeah. You can
months.
pay the entire rent in the beginning, the month of January. Like in some other countries, they pay rent for the whole year.
Okay.
So when they pay, that is called advance payment. That is prepayment. So how do you adjust for prepaid expenses? Remember, when it comes to income statement, we only recognize items for that particular year. Anything that you paid in advance, not for that year, is not recognized. If you pay rent, this is 2023, and you're paying rent for 2024 in 2023, that one that you have paid for 2024 will not be recognized in the year 2023. It's called prepayment. So now, how do you adjust the prepaid expense? So you debit prepaid expense account here. Prepaid expense, this is the adjustment, and you credit expense account. You credit expense. That is a double entry for that. Example, we have example there. ABC Enterprises incurred a total of 100,000 for wages for the year ended at 1st December 2009. So the total amount paid for was 120,000. 20,000 big payment for the year 2010. So now it was in 2009, the total amount that was supposed to be paid for 2009 for wages was 100,000. But they paid 120, 20 being for year 2010. So you need to adjust that one. So you come here and open wages account. So we have wages account here. And then here we have prepaid wages. Prepaid wages. So now the one that you, whenever you do a transaction is exchange of money for services or goods. It's a transaction. We call it a transaction. Double entry must be observed in accounting. So when they paid for rent, you credit the account that is losing, you debit the account that is gaining. In this case, wages is gaining from bank. So write here bank 120,000. So they paid 120,000. But we are aware 20,000 is not for the current year. It is for the next year, which is 2010. So we adjust it. We credit here wages. We said you credit, you debit prepaid expense and you credit expense. Expense is the wages. So here we're going to write here prepaid wages, which is prepaid wages, which is 20,000. And you debit here, we say here wages. We credit 20,000. So this one, I'm going to take it to the statement of financial position as an asset. As an asset. And this one, the one that you're going to recognize in the income statement is the one that relates to that particular year, which is 100,000. 100,000. That is 100,000. So that is how we advance for prepaid expense. So I've written there, prepaid expense should not be charged in the profit and loss account, but should be carried forward to the next financial period and should be shown in the balance sheet as a current asset. And I've given you an example. So that is prepayment, prepaid expenses. Any question or anything that is not clear?
You said something about it should not be in the profit and loss account.
Sorry?
The last statement you said, the prepayment, you said something about profit and loss?
Yes, I said prepayment should not be charged in the profit and loss account or the income statement.
Ah, okay, okay.
Yeah, so that is the reason why
Mm.
we are deducting them from the expense account. Okay?
Okay, okay.
That is correct.
Yes.
And then we go to B, we have what we call prepaid. We have prepaid incomes. So what is a prepaid income? A prepaid income, this is income that is not yet due, but cash has already been received for it. So this is income that is not yet due for receipt, but cash has been received for it. So it is like a prepaid income that is paid in advance. So how do you adjust it? Prepaid income should not be reported in the current financial period, but should be carried forward and reported in the period it relates to. So it is like you've been received rent for, you're in the year 2009 and you've received rent for 2010 in year 2009. So that for year 2010 is not for the current year. It should not be indicated in the current year's statements. It should be deducted and be carried forward to be indicated in the year it relates to, which is 2010.
10.
So that is how it is. So you should not charge it in the current income, you should not report it in the current income statement, and you should transfer it to the statement of financial position or balance sheet as a liability. As a liability. So we have an example there. A firm received a total rent of 200,000 for the year ended at 1st December 2009. So the total rent received was 200,000. Of this amount, 100,000 relates to the year 2010. Required, show the ledger accounts to record the above. So the total amount of rent that was received was 200,000, of which 100,000 does not relate to that particular year. It relates to the year 2010. So you have to show, to adjust, to indicate that particular transaction. So here we have the rent account here, rent income account. So we have said repeatedly that when you receive rent, when you receive income, you debit your bank account and you credit your income account. So you're going to write your bank, 200,000 was received in respect for rent. But we are aware, so here we have prepaid rent income. We are aware that 100 is not for the current year, so we need to adjust so that we remain with what relates to the current year. So we're going to write here prepaid rent. We're going to deduct prepaid rent here. We're going to write here 100,000. And there we write here rent, 100,000. So the one that you're going to indicate in our income statement as rent for that particular year is going to be 100,000, the balancing figure here. 100,000. Sorry, 200,000 here now, 200. And these are this prepayment, we're going to transfer it to the statement of financial position as a liability. So that is how we adjust for, for rent. That is how we adjust for prepayment. Are we together?
Yes, yes, sir. Yes.
So now, according to me, the two we have done, now we go to bad dates. We go to bad
debts.
Bad dates. So here we have bad dates. We have what we call bad dates. So what are bad dates? Bad dates, well, how do they occur? When sometimes we sell on credit, mostly when you're doing business in large quantity, you're selling in large volumes. So you only want to encourage sales. Mostly businesses will sell on credit so that they can attract customers. And some of these credit customers don't pay. And then when we have done everything that we can do within our means to recover that amount, and it proves unrecoverable, then we have to write the amount off. It will not be received again. So that amount that will not be received, we have already classified it as uncollectible. We call it bad debt. So bad debts, it refers to account receivable or debtors that has been specifically identified as uncollectible, and therefore it is written off. So that is an amount that has already been classified as uncollectible. We have done all the efforts and you are not fruitful. So you classify it as uncollectible. We call it bad debts. So how do you adjust for bad debts? Now that is the question in accounts. So the bad debts, you debit bad debt and you credit debtors. You credit debtors. You credit debtors. So you reduce it. For example, in a particular period, you have the debtors or account receivable. That is the same name. For example, you expect to receive balance brought down. You expect to receive 200,000 from your credit customers. 200,000 is the amount that you expect to receive from your credit customers. But one of them who holds maybe 20,000, whose accounts is 20,000 is declared bankrupt. When someone is declared bankrupt, it means that person cannot pay his debts. So there is no need for you to hold that amount in your account when knowing that you cannot receive it or you cannot recover it. So you write it off. So you come here and deduct it from your debtors here. You write here bad debts. Bad debts. That particular debtor that is already declared bankrupt. So you remove his amount from the account. So here you remain with those ones that are going to pay, which is now 180,000. Out of the 200, now the one that is going to pay, you call them 200,000. This one that have been proven not to pay or they are not going to pay, you write them off. And then you come here and open another account called bad debts, which you write here debtors, and you write here 20,000. So this one that you've identified as not going to pay, you transfer them to the statement of to the income statement or profit and loss account as an expense. So any debtor who fails to pay, within the required time, you are going to write them off or you're going to treat them as expense. And you only remain with those ones that we expect to receive amount from them. So that is how we adjust for debtors. Is that okay?
Yes, yes.
And then now that is, we go to what we call provision for bad debts. Provision for bad debts.
Bad debts.
A provision is just an amount that is set aside to cater for something that is likely to, an expense that is likely to occur or a loss that is likely to occur. A provision is an amount that is set aside to cater for any eventuality which might be positive or negative. Okay? That is a provision. Like we have provision for bad debts, provision for expenses. So that is a provision. It's an amount that is set aside to cater for an expense that is likely to occur. It's not that it's going to occur or it has occurred, but we anticipate it to occur, and therefore we set some amount aside to cater for that particular expenditure. Like for example, if you have small kids at home, those ones that have the immune system is not very strong, they are likely to fall sick frequently. You know kids, isn't it? So now, from your earnings, you set aside some amount of money, you spare it, that it can be able to cater for their medication in case they fall sick. It doesn't mean that they're going to fall sick, but you have just set aside some amount of money to stand in case, just in case. That is what we call provision. So there's an amount of money that is set aside from profit to cater for those debtors that are likely not to pay. It doesn't mean that they're going not to pay, but we are only taking precautions. So in case we have already stood in for them. So now we go to the notes. A provision is a provision for doubtful debts or allowance for doubtful debts. A provision is an amount that is put aside from the profit in order to meet a probable expense or a reduction in the asset's value. Provision for doubtful debts, it's an estimated amount of bad debts that will arise from accounts receivable that have been issued but not yet collected. So how do you now adjust for provision for bad debts? How do you adjust for provision for bad debts? So now how do you adjust for provision for bad debts? When you're creating for the first time, when you're providing for the first creation, when you're creating for the first time, you debit profit and loss account or the income statement. When you say debit profit and loss account, it means you treat it as an expense So that amount is going to originate from your income. And then you credit provision for bad debts. This one is very important. It's always tested. That is now on creation. Now in the subsequent period, so in the subsequent period, you've just set aside some amount of money, maybe 20,000 or 10 million or whatever, depending on the level of your business. So you've set aside 10,000 to cater in for those debtors that are likely not to pay. It doesn't mean that they are not going to pay, but you just estimated from experience. Now, in the subsequent period, you're going to analyze how was the response of debtors in terms of payment. Did they comply in terms of payments or those default? So we're going to do an analysis. If you find out that there was more default, then it will mean you need to increase this amount from 10,000 maybe to 20,000. So in case there is a huge default level, you're going to adjust that amount upwardly. So in case in subsequent year, in case of an increase, you decide that you're going to adjust it upwardly. You're going to increase it from 10,000 maybe to 15 or 20. So you're going to debit profit and loss account, and you credit provision for bad debts. In case now there was more, they complied and they paid more than you expected, there's no need for you to hold this amount in that account. Rechannel it back to business to circulate in order to generate more revenue for you, for the business. So you reduce it. Instead of holding 10,000 in that account, just an analogy as I gave out at the beginning, you have kids. And from your earnings, you set aside maybe 20,000 to cater for their medication. Then 1 month goes, they are not falling sick. Second month, they are not falling sick. Third month, they are not falling sick. So you decide there's no need for you to hold that amount in the house. You go and invest it somewhere else where you can get some money, isn't it? So you say now, instead of holding 20,000 to stand in for medication, let me hold just 5,000. Because these people are strong, are getting stronger and stronger. So 15,000 you reinvest, you can go and do something with it that is profitable. So that is what we're saying with bad debts. So you set aside 10,000 and you realize that the debtors are paying. So there's no need to hold that amount in that account. You rechannel it back to business so that it can generate more money for business. So in case of a decrease, that is in case of a decrease in the subsequent period, so you debit provision for bad debts, and you credit income, profit and loss. Anytime you hear credit income statement or profit and loss, it means you are treating that particular item as an income. So that is how we adjust for bad debts. Going forward, we're going to do so many questions on bad debts. But in the meantime, just know it that way. That is how we adjust it. Any question there? Any question? So that is how we treat provision for bad debts, adjustments. And then now we go to the last one, the last adjustment, we call it depreciation. Depreciation is the loss of value of non-current assets. When you buy assets in the business, they don't stay the same, they don't stay new forever. They lose time. So that loss of value of an asset is called depreciation. So there are reasons why asset depreciate. There are reasons why asset depreciate. For example, when you buy a motor vehicle, you don't expect it to remain new forever. It loses value with time. That loss of value is called depreciation. So there are factors that affect depreciation, the loss of value. So we have physical factors like wear and tear. As a result of using it oftenly, it wears out or it tears down. So that is, we call it wear and tear. And then we have also decay or rust or rot if it's not properly maintained, of which some assets are like that. Some people don't maintain the asset, so they decay, they rust. That one we call depreciation. Then we have economic factors, like maybe it becomes inadequate. You bought a particular asset when the business was at a particular level. Then the business grows, it outgrows the asset. So that asset does not serve the purpose. For example, you buy a Nissan to be ferrying stuff at some point. After some time, the business grows, and then now you
Hello, I can't hear you. Hello. Hello.
So now we can continue. There was some problems with the battery, but I think it's okay. We have rectified. Is it okay?
Yes, yeah, I can hear you. Can you hear me, by the way?
Yeah?
Can you hear me?
Yeah, I can hear you.
Oh, yeah, I was trying to ask a question about what do you call it? The previous topic, what was the name?
Prepayment.
Yes, the one
Or
for prepayment.
provision.
You said, yeah, increase in this part. You said increase in
Provisions.
where is it? Yes, when it's increasing, you debit the profit and loss.
Yeah, when it's increasing your debit profit and loss, when it is decreasing your credit.
So let's say when it's increasing, you mean like, let's say for the example of the children,
Yeah.
you set aside 10,000 for them.
But now you
That
increase it to 30.
or if you increase it to 30, so
Yeah.
you debit the
Profit and loss.
the 30.
You get it
Profit
now
and
10
loss?
to make it 30. Not 30. She already set aside 20.
So
So
it
now
was
you
going to be okay.
so you only the increment now you are going to make it 30.
Okay. And then I open another account for provision of
Yes.
bad
No,
debt.
the earlier one. The earlier one. You just use the earlier one.
Oh, okay. Do you mind showing me an example for how it's going to look at the accounts for that one?
Yeah, we're going to do examples.
Okay.
I'm changing the battery here for a while.
We are changing the
Oh.
back.
For just 1 minute.
No problem, sir. Take your time.
So you can continue. Huh?
So now we continue.
Yes.
So now we are looking at depreciation. The last one. Depreciation is the loss of value of non-current assets due to a variety of factors. And one of the factors we said it's because of wear and tear. Wear and tear is the wear and tear. And then we have wear and tear. And then we have economic factors like inadequacy, obsolescence. When you say obsolescence, would mean outdated. It's not spoiled, but it cannot be used. Like, for example, we used to have a typewriter. That typewriter, it was overtaken by computers. Nowadays, we use computers. You might have a very good typewriter, but it's obsolete. It cannot serve the purpose nowadays. So that one we say it is depreciated. Then we have depletion. Depletion is where you exhaust the asset, like maybe you exhaust the minerals through extraction. Then there's time factor, an asset that you're given for a particular time period. Like maybe you lease a land for 90 years or 10 years. So when that time lapses, we say that asset is depreciated. Okay? So because of depreciation, we need to provide for it as an expense. When you buy an asset, you have to anticipate, you have to provide for it, you have to recognize that it's going to lose value with the time. And because of that, you need to take that amount from your profit and loss account every now and then to save, so that now when that asset is no longer there, or is no longer viable, or is no longer useful, you can replace it. So that you have to provide for depreciation every year for the lifespan of that asset. Every time you buy an asset, the person you're buying that asset from will give you the period that you expect that to stay with that asset. We call it lifespan of that asset. A car, you're buying a car, the dealer will tell you that this car, you're buying this much, and it can serve you for this number of years. So within that particular period, every year you're using it, you spare some amount aside. We call it depreciation, isn't it? You save it.
Yes.
So that now when that asset is no longer viable or vibrant, you can replace it. Okay? So depreciation is an expense. It is like a saving you are making, so that when that asset is no longer useful or is no longer in good shape, you can replace it through the savings you've been making. Now, how do you provide? So method of calculating for depreciation. So there are methods that we use to calculate depreciation. And the most common one, we have two. We have what we call, how do you determine the depreciation charge for a particular asset? So we have methods of calculating depreciation. So they assist us to estimate the amount of depreciation to be charged in the income statement or profit and loss account as an expense. So the main method are, we have what we call the straight line method. So we have a method called the straight line method here. Straight line method. Straight line method, this method ensures you charge a uniform amount every year as depreciation throughout the lifespan of this particular asset. You charge, if you decided it's going to be 10,000, you're going to be charging 10,000 every year for that particular asset until the asset is completely written off, or for the period the asset is in business. So now we call it straight line method. We charge a uniform amount. A uniform amount is charged as depreciation throughout the useful life of that, throughout the useful life of that asset. Throughout the useful life, throughout the useful life, the useful life of an asset. You charge an equal amount. So how do you do it? So we determine it, number one, A, it is the cost of the asset minus the residual value or scrap value or residual value, scrap value over estimated useful life. Useful life. So every time you buy an asset, you have to determine how long you'll stay with that asset. Or B, you can take the rate, you can determine a particular rate times the cost of that asset. That is going to be, you're going to be charging it every year for the period you stay with that particular asset. For example, there, a firm buys a machine for 100,000. So the cost of that machine is 100,000, you can see there, which it expects to use the farm for 8 years. So useful life there is 8 years. Life there is 8 years. The machine will be sold for 20,000. So the scrap value, after 8 years, the machine can be able to be sold at 20,000. So determine depreciation charge every year for 8 years. So here you're going to write the cost, which is 100,000, minus the scrap value, which is 20,000, over life, which is 8 years. 8 years. So that one you get it is 10,000 every year for 8 years. That is 10,000. You're going to be charging depreciation as 10,000 every year for 8 years. Alternatively, you can determine it's going to be 10% on the cost every year. So if you've given the rate, you're going to apply the rate against the cost. So you're going to be 10%, for example. The rate is determined by the management, depending on many factors, times 100,000. So that one is going to be 10,000 every year for 8 years. So that is what we call straight line method of determining depreciation. Then number two, we only have two important, they test two methods. We have the straight line method and the reducing balance method. The reducing balance method, that is the method number two. We have the straight line and the reducing balance method. I hope you have understood the straight line.
Yes, I've understood.
Yes.
It's just a matter of subtracting the amount which is going to be sold after the year stated.
Yes.
Okay.
So we go to the next one, which is reducing balance method. So the firm determines a fixed percentage rate. The firm determines a fixed percentage rate that is applied on the cost of the asset during the first period of use. And the same rate is applied in the subsequent financial periods, but on the rate is applied on the reduced amount. So under reducing balance method, so you determine a rate, a particular rate, and then you apply on the cost in the first year. In the subsequent years, it is the rate times the written down value or the reduced value, written down value. So for example there, a firm buys a machine for 100,000 and it provides depreciation on machine at 20% per annum, reducing balance method. The depreciation charge to profit and loss will be as follows for the next 3 years. So here, the first year is going to be the rate, which is 20% times the cost, which is 100,000. This one gives you 20,000. In the subsequent year, which is year 2, second year, it's going to be 20%. Then you're going to take the 100,000 minus 20,000. That is the reduced value. And then you get 16,000. That is in the second year. In the third year, you're going to take 20%, and then you take 100,000, you minus 20, and then you minus 16,000. And then now you apply the rate on that reduced value, which is now 12,800. So that is how you do it. You accumulate the depreciation for the previous years, you deduct from the original cost, and then you apply the rates. That okay? So
Yes.
those are the two methods that we use to determine the value of depreciation. Now, after determining the value for depreciation, how do you treat it? So we have accounting treatment on depreciation. When non-current assets are depreciated, you debit profit and loss account. When non-current assets are depreciated, you debit profit and loss account, and you credit provision for depreciation account. When non-current assets are depreciated, you debit profit and loss account and you credit provision for depreciation account. That is the accounting treatment. You debit profit and loss account. In other words, you treat it as an expense. After you determine that value, either using straight line method or reducing balance method, you debit profit and loss account and you credit provision for depreciation account. That is how you do it. And then also, you need also to know accounting treatment, how accounting treatment when an asset is acquired or purchased. So this one is also tested alongside the depreciation. So when you acquire an asset, how do you treat it in your accounts? So when an asset is purchased, purchased or acquired, you debit asset account. The asset can be either motor vehicle, it can either be furniture, it can be machine, whatever. Either those, you debit the asset and you credit your bank account, or you credit the supplier, which you also call it the creditor, if you acquire it on credit. Okay?
Yes.
Now, in the case you dispose of an asset, number two, when an asset is disposed of, dispose means to sell it off or to do away with it. When an asset is disposed, you debit disposal account and you credit the asset using the original with the original value or the original amount. So those are the two entries that you make every time there is acquisition of an asset or disposal of the same. That is the adjustments that are made to the accounts. And then also, we also have some adjustments that you make in case of disposal. So adjustment for disposal, we have what we call adjustments for disposal, adjustments on disposal of an asset. When you dispose of an asset, these are the adjustments that you make. Number one, on disposal of an asset, on disposal of an asset. To dispose means to sell it off. When you dispose an asset, you debit disposal account and you credit disposal. You credit asset with the original cost. Not the amount of money that you're selling the asset for. And number two, with the accumulated depreciation on the asset that is being disposed of. This asset that we're disposing of, we are assuming that it has been in business for a while, and while in the business, you have been charging depreciation. Therefore, we have what we call accumulated depreciation on that particular asset. So you debit what you call provision for depreciation account, and you credit disposal account. That is number two. Number three now, with the amount of money received on disposal, with the proceeds, we call them proceeds on disposal, with the proceed on disposal, you debit bank and you credit disposal account. That is number 3. Number 4, with the balance in the disposal account, with the balance in the disposal account, with the balance in the disposal account. 1, if profit, you debit disposal account and you credit profit and loss account. 2, if loss, you debit profit and loss account and you credit disposal account. Very important. Those are very important entries. So now there is an example there I want us to go through to summarize all this about the disposal there. Example there. So so we have a company depreciate plants at the rate of 20% per annum, straight line method. So from the following details, draw up the planned account, provision for depreciation account, and disposal account for the year 2010, 2011, and 2012. So year 2010, bought plant costing 900 on 1st January, and bought another plant costing 600 on 1st October. Then we have year 2011, bought plant costing, it's supposed to be 550, not 500, but there's written 500. I think you can rectify that one on 1st July.
Okay.
And then in year 2012, sold plant which had been bought for 900 on 1st January 2010 for the sum of 275 on 30 September 2012. So now that is a very good example. We want to see it. So here we have the planned account. We're going to open a planned account here, which is this asset account, planned account here. So we said when you buy an asset, you debit the asset and you credit bank. That is the point we said. So here you write here year 2010. So we have year 2010. So on 1st January that year, they bought a plant for, you write their bank.
Yes.
100. You see?
Yes.
Then on 1st October that year again, they also bought another plant for how much? 600. So there's nothing else that happened in that year except for those two transactions of acquiring plant. So at the end of the period, you didn't close up. So here you're going to write here 2010. Then you, assuming that your financial runs from January to December, you're going to write here 31st December. Balance carried down, the closing balance is going to be the total here, which is 1500. So you write here 1500. You close off the account that year. Then come year 2011. So 1st January, you have the balance brought down. A closing balance in 1 year is the opening balance in the subsequent year, which is going to be 1500. And then you check what happened in the year 2011. So in the year 2011, you have been told there's an asset that was acquired at 550 on 1st July. So you write there 1st July, you write here bank, which is 550. Nothing else happened except for that acquisition. So you write here 2011, you write here 31st December, balance carried down. So it will be the total, the opening balance plus this new acquisition, which is 2050. So the balance carried down here will be 20, the balance brought down here will be 2050. So 2050. And then here 2012, 1st January, balance brought down, it is 2050. And then you check out what happened in that year. In 2012, there's nothing, there was no acquisition, but there was a disposal on 30th September. So right here, 2012. So right here, 30th September. So we said when you sell off an asset in the asset account, you eliminate the original cost. So here you write here disposal. We write here disposal. We said when you're selling it off, you credit the asset and you debit disposal. So this asset that was being disposed of was acquired on 1st January at 900. So you write there 900. The original cost, not the amount of money that was received for the sale. The amount of money that was received for the sale was 275. You don't credit with that. You credit with the original amount. There's nothing else that happened in 2012. Then now you balance off the account. So you write here 31st December, balance carried down. It will be 2050 minus 900.
I'm sorry.
Sorry?
You said that 275 is not affecting the 900?
The 275 is the amount of money that was received.
Okay.
Which we said it does not appear. It does not appear in the
plant account. Hello?
Oh,
Sorry, you disappeared. I couldn't hear.
oh, you can hear me now.
Yes, yes. You said the 275?
The 275 was the amount of money that was received for the sale.
Okay.
But the original cost was 900.
Yes.
So now I'm saying in the asset account, you credit with the original amount, not the amount of money that was received for the sale.
Ah, okay, okay.
Yes. So you credit here 900. You eliminate 900. Yeah. Okay. Are we together?
Yes.
Now the balance brought down was 2050 from 2011, and you sold off 900. So you remain with 1150. You remain with 1150. So that is how asset account appears. I don't know whether you followed.
Yeah, yeah. I followed.
Yeah. Now we come here and determine depreciation. They are using 20% straight line. 20% straight line.
Yes.
Okay. So we come here year 2010. Year 2010, there is what we call, they had two assets. The one that was bought in 1st January, it was 20%, it's going to be 20% times 900. This one stayed for the whole year in the business. So it's going to be 12 out of 12. So that one gives you 180. Are we together?
Yes.
And then there's this one that was bought in October, 20% times 600. Are we together? This one only stayed for 3 months in that particular year. So you're going to prorate, which is 3 out of 12. This is going to give us 30. So the total charge for 2010 is going to be 210 for depreciation. Are we together? Okay. Then we go to 2011. 2011. So this asset that were there from 2010 are there throughout 2011. They have not been sold. In 2011, they are there, isn't it? So 1st January, we have the balance brought down. Those are that came from 2010. The balance brought down is
Hello, it disappeared again. I'm sorry, I can't hear.
hello?
Yes, yes, I can hear you now.
Or let me do some changes here. Let me change my bed to first before we continue.
No problem.
Hello.
Yes.
Yeah, now we can continue. I'm saying now we are in the year 2011.
Yes. Do you mind starting that one? Yes.
Sorry?
Do you mind? Yes, starting that 2011. I didn't hear that part.
Yeah, 2011, I'm saying we had the balance of 1,500 that we brought forward from year 2010.
Okay.
So that balance, we're going to charge 10%, 20%. We're going to charge. So
20%.
the balance that came from 2010, it's going to be available throughout the year 2011. So that one is going to be charged 20%. And then for the whole year, which is going to generate around 300 as depreciation for that particular year, okay? So provided the asset is available, you charge depreciation for the whole year. Then now in that 2011, there was also another acquisition. There's an asset that was acquired on 1st July. So that one, we are going to charge it also. So we have 20% times, I told you it was not 500, it's 550, okay? And then now that one will stay there for 6 months, not the whole year. So you're going to prorate according to the time it was there in the business. So this one is going to be 55. So the total year is going to give us 355. Okay. Then we have 2012. 2012. So this asset that was acquired in January, it was only used for 9 months that year, isn't it? So
yes.
Right here, 30th of September. So there's 20 out of 100 times 900. That one is 9 out of 12. It was only used for 9 months. That one is going to give us 135. Then that other one that was there also, 600. Remember, there are two that were acquired in 2010 is still there. So we have another one. This is 20 out of 100 times 600 times 12 out of 12. This one is still there. So there was only one that was this other one. So we have a total of, that one will give us a total of 110. That will give us a total of 120. And then there's this one that was acquired in 2011, in July 2011, which will be there for the whole year, 550 times 12 out of 12. That one will give us 110. So the total will be 365. Now we open what we call an account called provision for depreciation account. We open an account called provision for depreciation account. So here you come and open provision for account. So we said when you charge depreciation, you debit profit and loss account and you credit provision for depreciation. So here in the year 2010, we're going to write here 1st January profit and loss account. Its total was 260. 210, not 260,
210.
210. So we're going to debit profit and loss and credit here. We write here 210. Then 2010, that year, 31st December, We're going to write here balance carried down, the closing balance, which is going to be 210. Then we close off that year 2010, 210. So sorry, 210, not 210, 210, 210. Then come 2011. So right here, 2011. So 1st of January, the balance brought down, which is the closing balance the previous year. It's going to be 210. And then that very year, we're also going to charge depreciation, which is 355. So we're going to add here 355. That is a deep charge for the year. So this one is also called accumulated depreciation account. So the total here is going to be 565. Then that is 2011. And then 31st December, you write here balance carried down, which is 565. 565. And then come 2012, 1st of January, balance brought down is going to be 565. Then that very year, profit and loss, they're going to charge, profit and loss, they're going to charge 365. 365, this one. So you add there 365. Now, for the asset that was sold off, it's no longer there in the business. So we need to determine for the business, for the period it has been in business, what is the total charge of depreciation for that particular period? And then we eliminate it. So it was this car, it was this machine that was bought in January. So in January 2010, the charge was 180. It was there for the whole year. 2011, in this 300, we have 180 that is attributable to it. So we're going to add 180 there. We're going to add 180. So the total is going to be, and then in 2012, they charged 135. So we're going to add 180 plus 180 plus 135. That one is going to give us 495. 495. So the total for the period that has been business is 495. This amount is in the opening balance. So we're going to write here 2012, 30th September. We're going to write.
Sorry, that figure 495. Do you mind repeating again? Where did it come from?
I'm saying we have this asset that was acquired in January 2010.
Yes.
For 900.
And the depreciation was 180.
For that is for 2010, isn't it?
Yes.
And then 2011 there's also another 180, which is included in the 300. Okay.
Ah, okay. Yes. So
that will be 360, isn't it?
Yes.
And then in 2012 they charged it 135 because it stayed in the business for only nine months, isn't it?
9 months. Yes.
Plus 135. That one will give us 495. Is it so?
Okay. So it's 180 plus
180
plus the second part is the one which is confusing me. You added
180
the
plus
depreciation.
180.
The depreciation for that day was another 180. It's in there 300.
Yes, in that 300. Yes.
Okay. Yeah. Okay. Now I get you.
You understood?
So
now that one, because we are selling it off,
we
are going to debit here. We're going to write here 495. Okay. We're going to debit the disposal. We're going to debit provision and the credit disposal. Okay.
That is money received now. That will be money received then 930. I mean 495.
That is the depreciation. 495.
Yes. Okay.
Now we add the 565, the balance go down, 565 plus 365, the charge for the year, which is 930, isn't it?
Yes.
And then we minus 495. We minus 495.
495.
So the balance, that is 31st December. 31st December, the balance carried down is going to be 435. I don't know whether you have understood there.
Yes, I have understood.
Now you're going to prepare the last account. You call it disposal account. I'm going to remind you what we said about disposal. We said, number one, when you dispose of an asset, okay, you credit the asset account. This is 900 you have credited here, and you debit disposal. You're going to write here cost 900. Are we together?
Okay.
The first step is when you dispose of an asset, you credit the asset account by the original cost, 900, and then you debit disposal account 900, the way you have done there.
Okay.
And then with the accumulated depreciation on the asset that you're disposing of, you're going to debit provision for depreciation, this one, and you're going to credit disposal.
Disposal.
So you're going to write here provision for DIP, which is how much? 495. And then with the amount of money that was received for the sale, the amount of money that was received, which is 275. You're going to debit bank and credit this disposal. So you're going to write here bank. Okay, 275. Are we together?
Yes.
Now you're going to compare this side and this side. If this side is greater than the 2, we say that is a loss disposal, okay? If this side is greater than the credit, that is a loss on disposal. So this is a loss of this is a loss of disposal by 130. So you write your profit and loss account 130, the difference. So that is that will be a loss. If the two sides are greater than the debit, then we say it's a gain on disposal. So that is yeah. Are we together?
Yes.
So you can do a summary, okay? So that is
sorry, you said I can do which one?
I'm going to send you some past papers.
Okay.
Then right away.
Okay.
And then I'll show you what the question to do.
Okay. Okay. Yes. Yes.
So I'm sending past papers and then I'll tell you what to do. The years to do.
Okay.
Okay. So now our class for today is we are going to stop at that point.
Okay. No problem.
So thank you.
And one question. I'm seeing the scheduling is a bit tough, and unajua mimi sitaki, I don't want to make you, I know you have so many other things, and najua kazi yako ni mingi. So I'm suggesting why don't we have just weekends? You know, I can study for myself.
That one will be it's going to be all right. Weekends, isn't it?
Yes, I can study for myself from Monday to Friday. Mimi na tupatane Saturday na Sunday, so that you show me everything too.
Okay, sawa.
Yeah, isitakuwa sawa hiyo around
iko sawa kabisa, inshallah.
Unajua inshallah. Yes, two iko sawa sio?
Sawa.
Tafadhali. Mimi nafanya hii, this is the only course I'm doing. I'm not even doing any other course. So ni unit peke yake nafanya.
Sawa. Sasa?
Yeah.
Ngoja nitumie assignment
Okay.
Haya.
Thank you so much, sir.
Welcome.
Naweza toka sio?
Narudi tena. Next Saturday.
Yes, sir.
Wasarima mama.
Samaki zunguleta pesa ndio leo zinakaa. Si pesa tu ndio inaleta. Pesa ndio inasema. Unataka samaki?
Rosarima Momo.